Good morning. Welcome to the show. I am Devin, and this is the Ethereum Bull. I'm honored to share this time speaking with Adriano, who is the author of the bull case for Ethereum, which is required reading to engage with us on this channel. For those of you on the journey about the future of the internet, you do have to read this, and to check that out, you can find it as a link on our YouTube channel or at Ethereum_bull. Follow us there, and you will find a link to the thesis. Check it out. So what do we do here? We talk about Ethereum in the context of Adriano's thesis and anything that the community wants to raise and talk with us. We do that through this podcast and on our YouTube channel, our Twitter, and we'll do spaces every other week, hopefully, to engage the community and potential investors and users as we go deep on the topic. And that brings me to the bull himself, Adriano, the author of the thesis bull case for Ethereum in the context of BTC. And I would like to jump right in and start talking with Adriano. If you want to find more about the show and interest, go back and watch the first episode. We've got a longer introduction there, but we're just going to hop right in with Adriano into the topics. So the first thing we're going to look at, Adriano, thank you so much for hosting us on Spaces last Friday. It was a good time, a heated debate. And we got into talking a little bit about institutional investment. It seems the audience could use some more information on the topic. So you were so kind as to drop a thread on Twitter. So I'm just going to pull that up and share it. And then maybe you could kind of give us a quick overview of what you're seeing as far as investors' interest in Ethereum. So let me just pull that up real quick.
Yeah, so as you're pulling that up, just to recap, we have this YouTube channel and we're doing the Twitter spaces as well. And we had our first Twitter space last week on Friday. And the point of the space is to talk about not just this thesis that I wrote for Ethereum, but also general the bull cases for Ethereum, and also invite a healthy debate with either Bitcoiners or people that are for Cardano, Solana, and other cryptocurrencies as well. But that space on Friday got taken over by this Bitcoin versus Ethereum debate in a way that I thought it wasn't very productive, because the guys that were engaging in the debate hadn't really read the thesis, were not really familiar with a lot of the information that we presented in the thesis and through Twitter as well. And it was quite unproductive. And so that I was asked, Devin's like, Devin, okay, next time, let's make some ground rules that, if we're going to have a debate, then let's have the guys that are debating us at least be familiar with the thesis. So it's not like, oh, you have to read this, but if you're coming in and you wanting to debate, spend the time to understand our thesis, and also understand the fact that we're not having these debates to be to find out who's the winner of the debate or anything like that. This is just a healthy discussion and in a friendly way, I would hope, and ultimately agreeing to the fact that this thing is super complex. No one has figured it out entirely. And there are different people, intelligent people, looking at this from different angles. And ultimately, we have to agree to disagree. This is something that, it's possible for people to have different theses and just respect each other and respect the differences between the theses. And I'm hoping that we can foster that kind of environment in our Twitter spaces. So, but one of the things one of the things that was brought up in this discussion on Friday that was quite frustrating was the idea that there is no institutional demand for Ethereum, and that there would never be institutional demand for Ethereum, or if there were institutional demand for Ethereum, that that would be even more institutional demand for different crypto assets like Solana or Cardano and so on. And there's already information out there about the degree of institutional demand that is happening today for Ethereum. And this is what this tweet was about. I was trying to make those points during the space, but it was very hard because people wouldn't, felt they didn't really want to listen to it. So that was kind of a follow-up to the space. So Devin, if you want to go over
I got
it
up now.
Yep.
So we've got, I think you make the case here in the thread about, why we're seeing the increase in demand and investment, and you've laid out a number of proof points here. So you want to talk a little bit about?
So this tweet again was just to bring up the fact that institutions are becoming more aware of what Ethereum is and developing a bigger and greater understanding of what Ether is in an asset, and that is being manifested not just through individual reports from independent investors, but also by official reports from financial institutions, and then ultimately in the market itself, right? So I'm just going to read the tweet here, and then we can talk a little bit more about it. Too many people in the crypto space are still in complete denial about the growing level of interest institutions have in Ether and its potential to overtake Bitcoin's market capitalization. It's time to shed some light on this subject. It is extremely difficult to understand Ether and Ethereum. This has been the source of a lot of information asymmetry, which is one of the reasons why there's seemingly no consensus regarding investment thesis for Ether as an asset. However, this is rapidly changing. An increasing number of retail and institutional investors are starting to view Ether as an asset with spectacular monetary properties. And for this reason, many respectable private investors and institutions are formulating theses that support the idea of Ether flipping Bitcoin, meaning the market cap of Ethereum becoming larger than the market cap for Bitcoin. In a nutshell, Bitcoin is viewed as a low-risk, high-friction monetary asset similar to gold, which is something we talked about before already, while Ether is starting to get recognized as a form of money that services its own digital economy where a new financial system is being built. It is also a yield-bearing asset that can be compared to an internet bond. That's related to staking, as we're switching from proof of work to proof of stake. Ethereum will provide passive returns for the validators. So right now, I think the yield is about 5%. That might go up, might go down a little bit, but the bottom line that it provides a form of return, passive return for long-term holders. That's something that doesn't exist in Bitcoin, not at least with negligible risk. And so that's why there's this analogy with an internet bond, and it has a higher appreciation potential, but also a higher relative risk. And that goes back to the fact that Bitcoin is pretty much ossified. There's just small changes happening in Bitcoin. And then Ethereum, there's still some significant changes happening to the protocol, and that comes with execution risk, and also comes with this not having so much clarity in terms of regulations, which is something that will probably change in the near future. But at the moment right now, Ethereum is in a little bit of a gray area where, there's a general consensus that it will not be classified as a security and that there will be no crackdown on Ethereum itself, but that's not official yet. So we're waiting for the new guidelines from the SEC for that. So
do you think that'll be a key, once we have that clarity? You're saying you've got all these, and I'm just scrolling through the rest of your tweets here. You talk about Grayscale, Roland Paul, etc. So what you're saying is, once we have regulatory clarity, we've got all of a sudden all these institutions, family offices that have been doing their research, have a thesis, see the value of Ethereum, and all waiting, and this will open some more floodgates to that investment.
Yeah, so the interest is there, and we'll go over the tweet right now. So there's already a lot of interest in this. There is a growing understanding of what Ether is as a form of asset, which is very difficult to understand. But at the same time, there's this gray area kind of fog of war that we have with cryptos in general, and where Bitcoin has a huge advantage there, because Bitcoin, it's outside of that gray area more than any other crypto asset. Ethereum comes in close second, but not as much as Bitcoin. But the silver lining of that is that there may be a lot of institutions and big investors that are on the sidelines waiting for that clarity to come, where if they're interested in Bitcoin, they don't have to wait for that because you already have enough clarity to invest. So when the SEC pushes out these new guidelines, that will be hugely beneficial for Ethereum, because now you're going to have this clarity for Ether as an asset. You're going to have this green light for investors to invest in it. And at the same time, you might be seeing this list of other crypto assets that are going to be forced to get listed from exchanges, which I don't think that it's a good thing for the space itself, but you have to look at the consequences of that, whether, I agree morally with that, or as the rights of investors to invest on whatever they would like to. It's going to be relevant to the effect that we have in the market. So when you have a list of assets that are going to be delisted for exchanges, everyone that is invested in that, we have to make, in the US, we have to make a hard decision of whether they want to hold, if they're holding Cardano or Solana or whatever else that is going to get delisted, they have to make the decision if they want to keep that and risk not being able to transact with it for quite a long time, because there will be no exchanges in the US that will be operating with it, and that they would have to wait until a time where there's some kind of exchange or some platform that operates with securities for them to sell it back on the market. So there's a risk with that, or if they want to sell it. And we already have precedents for that, because that happened with Ripple. So the SEC sued Ripple the end of 2020, and later, shortly after that, Coinbase and other exchanges in the US announced that they would be delisting Ripple from the exchanges. And there was a time span that they gave to users of about 3 weeks to figure out what they wanted to do, if they wanted to sell it, if they didn't want to sell it. And in between those 3 weeks, a lot of people did sell Ripple, and the price had a big hit for Ripple, because people didn't want to hold something that they didn't know what was going to happen with, and they didn't know how long they would have to hold it for until they would have another opportunity to transact with it. So, so the price of Ripple took a big hit. But interesting is that in those 3 weeks where there was an announcement that there would be a delisting and the actual delisting, there was a shift of capital of these people selling Ripple and putting their money somewhere else. And some of it, I'm sure, sold Ripple and bought Bitcoin. Some sold Ripple and maybe just had cash, and some sold Ripple and bought Ether and Ethereum. And the price of Ether versus Bitcoin in those 3 weeks that there was the announcement of the delisting and the actual delisting went up by 30%. So why is that? Well, if you're a person that is invested in these other crypto assets, that people call it altcoins, and now you're having to make the decision of liquidating whatever invest you had in that, and then either holding cash or having some kind of other crypto asset, Ether is a lot more attractive than Bitcoin, because it fits that profile of higher risk, higher returns. So when we have this event that is going to happen at some point, where there will most likely, there will be several crypto assets that will be forced to get delisted from Coinbase and Gemini and the other major exchanges in the US, you're going to have the same thing happen, but bigger, right? So there's going to be a lot more money that is going to be moving around. And the likelihood is that these people will be putting more money into Ethereum than Bitcoin, because they fit the profile, not of just in the type of investors, but the type of investment itself. So if you're an investor that has a diversified portfolio and you have some money allocated into Bitcoin and then Ethereum, some altcoins, well, when you have to take out of altcoins that you're pushing out on the risk curve, the closest thing to it might be Ether. Is definitely closer than Bitcoin. So there's going to be a shift there. So that is all related to these new guidelines that the SEC is pushing out. But regardless of that, you're going to see also when the new guidelines come out, you're going to see on the other side of institutions actually that were just waiting, that might not be invested in any crypto at all, or maybe they have Bitcoin and they were waiting to have more clarity with Ethereum. They're going to get that. So the interest that is building up right now is going to go even higher, and it's just not the level. You have to look at the trend, right? At the momentum. It's not just, you don't look at just, okay, what is the interest today, and that's it. You want to look at how that is evolving over time. And you can see that in the space, if you're paying close attention, that the way that this is evolving is that there's a rapid growing of interest in Ether. And part of the reason of this growing interest is this aspect of Ether being an asset that bears interest. So it's uniquely positioned for that, because it's the only asset of its magnitude that has so much liquidity and has the Lindy effect, because it existed, it's been out for quite a long time, and it has the trust and the name recognition and so on, that is going to be generating yield. That's very unique, and it's something that is generally being overlooked by, I don't want to say Bitcoin maximalists, but by general people that are not looking at Ethereum in a favorable way. So let's look at some of these numbers, right? So going back to the tweet here.
I got it up.
How did the trend of increased interest, how did that start? Well, it started with Grayscale, and Grayscale has the Bitcoin and Ethereum funds for traditional institutional investors. And they reported that they were seeing a new group of investors who are Ethereum first, and in some cases, Ethereum only, meaning that where originally the big investors were just looking at Bitcoin, at some point last year, they started seeing a change in behavior and interest, where some were actually also interested in Ethereum, and then some were more interested in Ethereum than Bitcoin, and some were exclusively interested in Ethereum and not interested in Bitcoin at all. So that's from Grayscale. And then not too long after that came out, Raoul Pal, who is a very famous investor, and he's the guy who went irresponsibly long. He created that terminology to describe that he went all in crypto, where he also originally went all in Bitcoin. He gradually shifted his portfolio towards Ethereum. And then in a recent interview with Bankless, he recognized that Ether is money, which is a very important piece of the investment thesis and valuation for Ether as an asset. And today, his portfolio is consisting of 70% of Ether, and only, I think there's only 5% of Bitcoin. So that's not too different from a portfolio allocation. If you look at Ray Dalio, right, where he's a hedge fund manager, and he has a thesis for portfolio balancing, where traditionally he says, well, people should allocate about 8% in gold, because it is this high friction, low risk asset that is uncorrelated with everything else. And even though that's not still the case for the relationship between Bitcoin and Ethereum, it's funny that Raoul Pal is now not too far off from this type of allocation, where Bitcoin is only actually a small percentage of his portfolio, and a bigger percentage now is allocated much bigger into Ethereum, and then some other crypto assets that have even higher risk, but potentially higher returns as well. So that continued. That was Raoul Pal. And obviously he has a lot of connections. He has a lot of billionaire friends and acquaintances. And you have to take into account that they probably listen to him for advice investing in the crypto asset class. And they might be mimicking this type of investment portfolio distribution that he has done himself. And so that's something also that we should be thinking about. And then Goldman Sachs pushed out an official report recognizing Ethereum as a store of value and a digital currency that could potentially overtake Bitcoin. There's a link to the report here. We're not going to go over it, but the general idea, you're going to see this theme where the general idea is that institutions and big investors are recognizing that Ether is not all that different from Bitcoin, in the sense that that narrative that Ether is just this digital oil is starting to morph into, well, Ether is actually, yes, it's digital oil, but what does that mean? Well, it means it's actually digital money in the digital economy. That's what it means. And that's essentially what Goldman Sachs says, and then is also what leads to the conclusion that Ether will be something much bigger than Bitcoin. And then the end of the second quarter, Coinbase, which is a public company now, they pushed out their financial reports. And in their financial report, there was information about the trading volume between Bitcoin and Ethereum. And Ethereum had a higher trading volume than Bitcoin. There's a 26% of the trading volume from Coinbase was Ethereum, and 24% was Bitcoin. That's the first time that ever happened. It's a very important piece of news because Coinbase is one of the biggest exchanges in the world. It's the biggest in the US. And a large portion of that volume was coming from institutions, because institutions actually were the biggest participant in trading at that quarter. If you look at the trading volume for the second quarter of 2021, retail investors was $145 billion, where institutional investors were $317 billion. So the majority of the trading volume came from institutions, and the majority of trading volume went into Ethereum. That's big. And then there's also a piece of, something that is smaller, but that is also plays a role in this, is that, the BTCs, the dominance in the futures market was also challenged by Ethereum, where the futures for Ethereum were pointing a little bit higher than Bitcoin. It's a smaller news, not as significant, but also fits into the general idea there. Institutions are starting to look at Ethereum too, and futures being an instrument that institutions use a lot, and that pointing higher than Bitcoin is signaling something that is aligned with the rest of our thesis here. And then yet another big institution, Standard Chartered, is the fifth largest bank in the UK. They pushed out a report with projections for price for Bitcoin and Ethereum. And in their report, if you look at the prices that they're projecting, they're predicting that Ethereum will flip Bitcoin. They don't say that, they don't use those words, but implicitly, if you look at the price projections, Ethereum is going to have a higher market capitalization than Bitcoin. That's huge.
Wow.
All right.
Yeah.
So long story short, Bitcoin maxis have lost the plot, and they have become the Peter Schiffs of crypto. Bitcoin is digital gold, but Ethereum is something much bigger than that. Institutional demand is here, it's growing, and nation state demand will eventually come as well. That's something really big about nation state demand, because we are not seeing any of that right now with Ethereum. We are only seeing that with Bitcoin. But there's a progression of investors and different layers of categories of investors that you see repeatedly across the board in terms of crypto assets, where retail investors first started with Bitcoin a long time ago, and then they moved to Ethereum. And then also retail investors, but bigger names in investment like Ro Paul also started with Bitcoin and moved on to Ethereum.
Yeah.
And then institutional investors also started with Bitcoin and then moved on to Ethereum. And then the last layer here is nation states, and they will also follow that path, where they will start with Bitcoin and eventually move on to Ethereum. Not all of them will do that, but certainly some will. And the
Yeah.
question is, okay, what percentage of the market will be invested in just Bitcoin? What percentage of the market will be invested in both? How would that be balanced? And what percentage of the market will be invested maybe just in Ethereum, not even Bitcoin? And you have to think about also that it's very interesting that Ethereum, with this change to proof of stake and the participation that grants the stakeholders of Ether to be able to validate transactions by holding Ether, the asset itself, and participating in the actual functioning of the network, it means that now Ether is a productive asset. And you have big investors like Warren Buffett that will not invest in gold or in something like Bitcoin because it's against their investment thesis. So where Warren Buffett and the likes of Warren Buffett would not be putting money into Bitcoin because the same reasons that they don't put money into gold, because it's not a productive asset, they would be open to putting money into Ethereum. And just Ethereum has this bigger potential to capture different types of investors. So I think it's
in the
something that we have
past,
to do.
In the past, you've used it. Well, first of all, thank you for putting together this thread. I think it's great for a couple of reasons. It provides more clarity of what we've talked about in spaces, and more importantly, folks, through the tweet, Adriano's pointed us to some key facts and proof points that there is this growing demand in institutional investment. So we'll continue to track and monitor that for everybody. But I think the reason that is happening goes back to the thesis, Adriano. And one thing in a chat we had a while back, you phrased this term called ETH is equity money. And I was like, that sounds right and great, but let's talk about what that is. So why don't we go to the thesis and kind of get into what is ETH, your view, go a little deeper into the properties of the asset, and talk about it as a form of money and what you mean by money, equity money. Okay.
Yeah.
I'm just going to start sharing the thesis here.
Yeah. So this is something that, it's not just me saying that Ether is money. A lot of people have been saying that for quite a long time. And different investors have come out to the same conclusion independently. And one of the biggest proponents of that right now that is very well known is Bankless, right? So they've been saying that for a while, but I just look at it in a slightly different way that they do. But generally, we're like aligned, I'd say like 90% of the thesis, and other guys as well. But why is Ether money? We're making this assertion that it is, but there's a lot of evidence and critical thinking that went into that to back that idea that Ether is money, right? And you might have seen also comparisons of Ether to different assets, like we just mentioned. There's this relationship of Ether as an internet bond. You could look at Ether as this kind of growth tech stock where there's a lot of activity happening and big cash flow, and you could use a valuation model for that. You could look at it as a consumable resource where there's this burning mechanism to it, and there's just a different ways that you can look at it, but at its core, Ether is money, right? So let's look at the thesis here and just read why we can come to that conclusion. So even though we can draw parallels between Ether and a multitude of assets, at its core, Ether is money. And it is more likely to become a global currency than Bitcoin. But why? Ether was created to finance the security of the network. It was designed to provide remuneration for miners. Ether is used to pay miners, and issuance is a form of subsidy. Its sole purpose is to function as a utility token, which is just a form of money that has a very narrow scope. And this is true for all proof of work networks. So that just means that the creation of Ether as an asset itself was deliberately done to be part of the economics of the system, where miners were going to get paid with that asset, with Ether, and that because transaction fees were not high enough yet to sustain the finance, this operation financially, then there's a form of subsidy that needs to be introduced in the form of creating more coins, and that's the issuance. And interesting enough, I don't know this, but in the Bitcoin code itself, the calculation of how many coins are created for each block, it's the name of the function is get block issuance. Excuse me, get block subsidy, right? So so the name subsidy and the idea of issuance being a form of subsidy was well understood even in the very beginning, the days of Bitcoin, where in the code itself, the amount of Bitcoins that get created, the name of the function is called get block subsidy. So, and the idea that now we have this asset that is an utility token, meaning, well, you're going to use this thing as a type of money in a similar way that you use like a carnival ticket. If you go to a fair, right, and you go to these festivals, and before you get to spend any money and buy a beer and go on rides, you have to change your money to this little ticket, and then you can use the ticket to pay for the beer or the hot dog or or the ride that you're going to. And that is actually a utility token as well. And if you look deeper into what a utility token is, well, what's happening there? You have this ticket where you're going around and they have this microeconomy, and everything is priced in this ticket. You're not looking at dollars anymore. You're looking at how many tickets you need to use to buy your beer or to ride the ride. And so that's a unit of account. That's one of the functions of money. And then when you pay for it, you're going to give that ticket away to that person. So that's a medium of exchange. That's also one of the functions of money. And also for the duration of the fair or the festival, you're expecting that when you buy that ticket in the beginning of the day, at the end of the day, you still be able to buy, if you could buy one beer with a ticket, you're expecting that at the end of the day, you could also buy one beer with it. So it's a store of value in a very, very small time span, but it's servicing its purpose of being money in all 3 degrees. And that's also true for Ether in the Ethereum economy, when it started as a utility token being used to pay for the Ethereum service, right? The service that Ethereum provides is the ability to transact in the Ethereum network. And the way you pay for that is with Ether. And the fees are actually denominated in Ether as well. And when the miners receive that, well, they're getting paid with Ether because it has value, and they need to cover their costs and be financially incentivized for that. So that's what the little section is about. But it's important to understand that the scope of Ethereum, the scope of Ether as a monetary asset for Ethereum, has evolved from this utility token being something that is very narrowly scoped, meaning you just use that to pay for the transaction fees. It evolved into something else because there was a market that was created in Ethereum around Ether as an asset. So let's continue here with the reading and looking at the fact that the interesting thing about Ether is that its scope as a form of money is expanding rapidly within Ethereum's digital economy. It has become the preferred asset used to facilitate economic activity involving ICOs, involving DAOs, decentralized finance, and NFTs. And whatever new use cases we're going to see in the future is probably going to be using Ether as well. So Ether is the native currency of Ethereum. It is not a commodity and never was one. There are several reasons why users choose to use Ether as a form of money. Number one is that it eliminates counterparty risk. So Ether being the native digital currency of Ethereum, it eliminates counterparty risk because there is no third-party custodian involved for that asset. Is, that asset is just part of the protocol, and when you're transacting with smart contracts that is also secured by the protocol, there's zero counterparty risk there. So that's really big, because that's friction, and is eliminating the friction of counterparty risk. And then also Ether has excellent monetary properties. So we're seeing now that Ether is becoming this deflationary asset because of the economics of EIP 1559 and the switch to proof of stake, which reduces the amount of issuance that you need for the system. And very, very soon, we're going to see a sustainable monetary policy that doesn't need to be adjusted anymore, because you have this dynamic with EIP 1559. And it's going to be, on the long term, is either going to be near zero net issuance or a deflationary negative net issuance. So excellent monetary properties for scarcity, but also excellent monetary properties because Ethereum has full programmability capacity. And with that comes with, this smart contracts that create DeFi, that create all kinds of things, DAOs and other types of interactions that are secured by the network itself, and they eliminate counterparty risk, right? So the counterparty risk that you get, the elimination that you get from the asset itself of Ether as a form of money, is also eliminated when if you're buying like an NFT that is natively inside of Ethereum, because now you have this smart contract that can do that, can execute that transaction, and everything is just sustained with the security assertions of the network itself. 100% no counterparty risk there. So that's really important. It's one of the reasons why Ether is used as preferred form of money.
I love this piece of the thesis too, Adriano. Maybe you could just spend a minute on that. A commodity, currency, digital. I think that's a good overview when you say this is equity money, more than money. Maybe talk a little bit about some of these components.
So the equity money comes really from the idea that Ether, it is a bear asset, but it's an asset now that where with the transition to proof of stake, is an asset that will grant you the rights to participate in servicing the network. Meaning once you become a validator, you'll be allocated a little section of rights to process transactions. And when you do that, and in the process of participating in that, you're going to get paid for providing this service for the network. So the network has a value because the service is valued by the users, and the ownership of Ether, it's equivalent to owning a piece of the network itself. So that's where the equity comes from. And it's different from, first of all, it's different from Bitcoin, because Bitcoin is more like just a bare asset raw commodity, because the network is serviced by miners. The transactions are processed by miners. So the ownership, being a stakeholder in Bitcoin, doesn't give you really equity in the network itself. It just gives you ownership of the bare asset. And then there's a correlation between the network and the value of the bare asset, but it's a different dynamic of actually being able to participate in the consensus mechanism that you get to do with proof of stake. So Bitcoin, you still have to look at it more as a commodity rather than equity money. And then compared to fiat money, that's an even bigger difference, because fiat money is really just debt money, where the creation of new money in our system today is done by the issuance of debt. So when the government needs more money, they issue bonds, and that's how they get more money. There's debt behind that money. So every time the government is spending more money, and there's this creation of money, is done through the creation of debt via bonds. And then the Fed is facilitating that, because they are an intermediary for either operating with that, or also to establishing a base floor demand for it, which is what we're having right now. So the Fed is increasing the balance sheet, and essentially they're creating money out of nowhere, but they're actually creating demand for government debt. That's what is happening. The Fed is creating artificial demand for government debt, and it's artificial because they don't have the money. They're just buying that's with no money. They're just putting on their balance sheet. And in doing so, they are keeping the floor price of the bonds up. And that really means that this debt can be issued with a lower interest rate that it would be in an open free market where there's no artificial demand for it. But long story short, fiat money is debt because everything is backed by the dollar today, and the dollar is just government debt. And once that government debt goes into the banking system that we have today, well, we have a fractional banking system that creates even more money in the form of debt as well. Because now, if you deposit $100 in the bank, then I don't know if it's still true, but at some point where this whole crisis started, they reduced the fractional, the reserves demand to zero. So that means that banks could borrow your entire $100 to anyone they wanted to. There were zero demands for reserves. And that was kind of something that people glanced over. No one was paying attention to that. It's like, are we not seeing this happening?
Yeah, really?
So I don't know if it's still happening. It wasn't like that. Usually there was a limit that where banks had to have some kind of reserve, meaning they couldn't lend out. If you put $100 in the bank, they just couldn't lend the $100 out. They had to hold, $10 or $20, or at least a fraction of it. But every time they lend out money that is not theirs, and they're lending your money, well, that's a form of debt creation and creation money through debt. And that's why when the debt is bad, when you have this huge accumulation of debt and the debt is bad, the value of the money is destroyed. In what form? Well, the bank defaults and your money is not there and you lose the money. You have the problem is the people that are using the system get the short stick, right? So, so that's, a key difference for Ethereum, not just in the form that it's a form of money that now it's equity money, but also in the fact that the system itself is designed in a way that minimizes the incentives to create these fractionalized systems that we have in traditional finance. And that's something that Bitcoin doesn't do as well because of the limitations of transactional capacity of the system itself. Not directly related with the monetary policy or any of that, but it's just really related to the fact that if you want to use Bitcoin as a form of money at a mass scale for the whole world, you're going to end up needing to use these different networks that like Chivo and like Strike that are not transparent and that can disconnect from the bare asset. Meaning, if Chivo, the El Salvador wallet, all the people that are transacting with it and depositing Bitcoin in it, well, there is no way to audit how much Bitcoins they have on their reserves versus what they're showing that the user balance is. So they can fractionalize that system in a way that they can fractionalize, they can have a balance of Bitcoin that is lower than the total balance of users have. So let's say that they have 100 Bitcoins or 1,000 Bitcoins in reserves, and then the total user balances that up maybe to 2,000. They could be doing that now. There's no way to verify that. So this is horrible because they can do that covertly. And if you're government doing that, you can do it covertly because there's no authority that is going to be checking on that. There's no Bitcoin IMF, right? There's no superior authority that is going to be overseeing what governments are doing. And that's
because
why
of the custodial.
Well, because it has a custodial nature, but when it's a little bit different, like when PayPal is doing custody, because in theory they can be there can be oversight from the governments on top of it, right? And then it's not perfect, but it's better than the government doing it itself because now there's no oversight at all. There's nothing. There's no authority over it.
There's no
they
authority.
Can say, are you really? No, are you really doing? Do we have full reserves?
Right.
Are you really doing? There's no one's checking for that because that's the way decentralized networks have. But the problem is, if you have that phenomenon happening where people are relying on custodial wallets or are preferring, and maybe, maybe they don't have to rely. You can say, well, they could, cash out and have the money outside of Chivo. The problem is that there are incentives for them to do that. So as long as they're engaging in this behavior, and you see a concentration of value in this custodial wallets, and worst of all, in state custodial wallets, or nation state controlled custodial wallets, now you're introducing the possibility of fractionalization in a covert way, meaning it's not open. You don't know if they're fractionalizing or not. Are you going to trust the government of El Salvador? Would you trust them to make sure they have 100% reserves? I wouldn't. So would I?
They're not.
Yeah. So
why
we
would
have this
they?
dynamic. You're going to see this repeatedly. Other countries will do the same thing. They will introduce, governments will introduce state wallets. Well, it's very interesting for them because if you're operating that, you have this ability to fractionalize the system, but you also have this ability to monitor everyone's activities directly because you're just operating on their private network. Yes, you can withdraw from it, but you can also go to the bank and withdraw cash, right? That's the same argument. Well, I can go to the bank and withdraw my cash, so it's no big deal. What's wrong with the banking system? Well, you can only withdraw the cash if the cash is there to start with. And if everyone figures out that the cash is not there and they try to withdraw, then they can't. So that's the problem. And the bigger concern is that with Bitcoin, the way it works, the exit door is not there for everyone, because if everyone decides to withdraw at the same time, or even through a span of time, there's just not enough bandwidth in the network to do that.
Right.
And that's
with the Chivo custodial wallet would have the same problem if everyone was trying to withdraw the.
Yeah, because it's not a problem with Chivo, it's a problem with the Bitcoin network.
Yeah.
So we go back to about 6
Layer
transactions
1
per second.
Yeah.
Well, you have now Lightning Network on top of it, but Lightning Network, if you really want to be self-custodial, you have to open your own channel, and to open your channel, that means you have to transact directly on layer 1. So it goes back to the 6 transactions per second, and that's a problem.
Yeah.
So so Bitcoin, Ethereum different, but again, Ethereum is evolving as a form of asset in the system because of this dynamic where there's an economy being created in Ethereum, because Ethereum is a platform that allows you to program anything, and we're seeing these use cases emerging from it. And as these use cases emerge and value is being created in the form of NFTs and DAOs and other things, a lot of users, most of the users, have decided to use Ether as the primary form of money for this system. And when they're doing that, it's creating a market around Ether that started, it started again with the fact that Ether was needed to be, for every user of Ethereum, because it was the only form that you could pay for the transactions. So everyone that is participating in Ethereum had to have Ether to start with, because you needed to pay for the transactions. And because everyone has Ether, it kickstarted this market where now there's a commonality between all the participants, where they have this asset that also happens to have excellent monetary properties, that also happens to eliminate counterparty risk, that also happens to be aligned with the ethos of Ethereum, where it's about decentralization, it's about being self-sovereign, and also the fact that all these participants that were early on in the Ethereum ecosystem from $1 to $3,500 in a matter of a few years. Now you have this large amount of people, you have a huge number of people that are multimillionaires that are very aligned with the ideology of Ethereum, that are very eager to spend and reinvest their money in the Ethereum ecosystem. So they are helping to drive the demand for Ether as a form of money, because they are, they are part of the customer base for it. So if if there's people issuing NFTs and digital art, who's going to be buying that? Well, a lot of these guys are the guys that in their OGs, that are guys that have been there for a long time, and they have
Yeah.
a lot of money, and they're driving the market. So you have this, several components that are coming together, and there are very strong incentives for Ether to be used as a form of money in this digital economy. And you're only going to see that grow and grow and grow. So the scope of Ether, bottom line is that the scope of Ether as a form of money is growing. And also the fact that because Ether is an appreciating asset, rapidly appreciating, and it has this internet bond dynamic and a lot of incentives for people to hold Ether regardless of participating in the economy or not, you're going to see that being transported to the real world in the form of using Ether as money in the real world as well. It's not going to happen in the form of people buying hot dogs or coffee with Ether, but it's going to happen in the form of expensive purchases. So meaning, if you're an investor in Ether and you are allocating part of your wealth that would be normally allocated to investments or to a savings account in Ether, down the line, you might want to liquidate some of that to purchase something for yourself. So it could be a house, it could be an expensive car or some kind of luxury item. And it would be, when you come to that moment where you have to spend a large amount of money, you're not going to have that in your cashing account. You get in your checking account, you're going to have that in your investments. And Ether being an investment, now there's a motive, a reason for you to liquidate some of that to buy a house or a car or so on. But because the network itself can transact with both parties directly, meaning, it's not like having a stock where it's difficult to change ownership of the stock to the other party that you're transacting with. Now you have a way to liquidate that asset directly in the transaction that you're engaging with, meaning you can use Ether as a form of money for these expensive things. So if you're buying a car, instead of having to sell Ether for dollars, and then using the dollars to pay for whoever's selling the car, you can just give the Ether directly for who's selling the car. So you're going to see this transition where, and this also happens with Bitcoin, right? So it's not just Ether, is Bitcoin and potentially every other cryptocurrency that is well established. But the interesting thing is that in Ethereum, there's this parallel economy that is happening in the digital domain. So where on the high end of things in the real world, you're going to see people starting to use Ether and Bitcoin and others as a form of money for expensive things. You're going to see this other economy evolving inside of Ethereum for things that don't exist in the traditional economy, or that maybe exist, but not with the properties that you have inside of the Ethereum, of being, eliminating counterparty risk and having persistence and permanence and other things. So that is a huge push for Ether in terms of demand for that asset, and that will help it to appreciate in value faster than Bitcoin. And ultimately, if it's appreciating in value faster than Bitcoin, it's also going to have at some point higher liquidity than Bitcoin. We're close to having that, and it's just going to have a higher adoption. And with the higher adoption, higher liquidity you have for the asset, it's going to manifest itself in the real world, where more people will start using Ether as a form of money for real things. And gradually, as this asset matures and the price starts to stabilize, you're going to see the ceiling of what Ether is spent in the real world being reduced. So maybe initially we're spending that just for like houses and cars and luxury items, but then that ceiling is going to gradually go down. And then now you're going to be spending maybe on a computer or, on something less expensive. And eventually you're going to see people, spending Ether in cheaper and cheaper things. And it's going to be this gradual progression where at one point people are just going to be living straight off of Ether and being paid in Ether and then transacting, and then eventually buying your coffee in Ether.
I think what we know, two things about the internet is when it's seamless, it works. So when you think of the seamlessness, and most of us that utilize ETH for all the things you're talking about, do so because it is very easy to do once you understand how it works. So yeah, I think that'll continue to grow as we see more and more adoption and frictionless services. I mean, the pace of innovation is staggering. Every week there's something entirely a new invention. So, that's a good spot to end this week, and maybe next week we'll look at some of the just the thought I had as a potential topic, or maybe we broach it on Spaces. But what are some of those kind of innovative transformations that are happening on the Ethereum network that we think are really leading indicators of where this is going?
Yeah,
Similar to
there's
the way you
one more piece
shared
of information I wanted to share, because
Oh,
we're
sure.
talking about this. What is the size of this economy that exists inside of Ethereum? And it's hard to calculate. If we could calculate a GDP, it's kind of hard to do that. But just based off transaction fees, Ethereum is generating about $18 billion of cash flow per year alone, on fees alone, between L1 directly layer one fees from Ethereum itself, and then the fees from the dApps, which are in large part collected with Ether. And that $18 billion of cash flow per year of the services that are being built on Ethereum is equivalent to about 73% of El Salvador's total GDP. So where, Bitcoiners are trying to point out, oh, you see how, Bitcoin has been declared officially as the legal tender in El Salvador. Well, we don't know how much of it is, people are actually using to facilitate economic activity in El Salvador, but I can guarantee you it's not going to be anywhere near 73% of El Salvador's GDP. It's not going to be facilitated by Bitcoin. It may be something like maybe 2 or 3%, if that.
Mm-hmm.
But on that note, while Ethereum is already generating, it's like a little country. You have to look at Ethereum as being its own little nation, and just on fees alone, it's almost the size of El Salvador. It's like its own country that is primarily using Ether as a form of money. And it's not just as a form of medium of exchange, which is what happens in El Salvador, because no one in the right mind would be pricing real goods and services at this point, denominating that with Bitcoin, because it's too volatile. But in the Ethereum economy, this digital economy, in the multitude of reasons, it actually, people are doing that. Yeah. And the fees are denominated primarily in Ether, and NFTs are denominated in Ether, and so on. So you have to look at that as well, where there's a lot of activity already existing in Ethereum as its own little country that is rapidly growing.
Yeah, 100%. I mean, I think with some of the trading inside the communities with NFTs, I think people really see ETH as the value. So they value things in ETH. That's an ETH. That's 0.2. That's 0.5. So to your point, I think culturally, we're seeing a big shift inside the community where everything's denominated in ETH. And people understand it really well, and people really understand the value of the fees. Like, we don't complain about fees on the Ethereum blockchain per se, because A, we know what's being done to reduce those costs, and B, because we believe in the value of the service in which that fee transacts, and it's invaluable. So yeah, anyway, I think great add on there. So yeah, I would love to see us talk more about how we see kind of the future coming together in reality, and maybe find some of those great opportunities. So we'll be watching your tweets to see if you pop up any of that good stuff. Okay. Were there any other key tweets that you wanted to talk about before we hop off here?
No, I think next week I really like to address something. I'm just going to leave it out there that we're going to be talking about. This is that the idea that the dynamic nature of Ethereum's monetary policy being adjusted over time makes it similar to traditional monetary policy, and that it can be abused, and that it can be debased, and all of those ideas that needs to be addressed.
Do you want to do
Because,
that in Spaces next week,
um,
or do you want to do a show?
we could. It doesn't matter, we can do a show, we can do space. Primarily also, the idea is that proof of stake makes the richer get richer, which is insanity, because it doesn't. It actually, it's there's a lot more forces in proof of work to make the richer get richer than there is in proof of stake. So,
Right.
and I have this little example that I thought about that I can show, and like put on a spreadsheet and actually show some numbers, like, okay, here's why with numbers the richer don't get richer, and it's like just walk through and demonstrate that. So that's what I would like to do.
All right, that's definitely something we'll do on a show then.
Okay.
But I also like the idea. I also like the way we do, like, maybe this is the routine, right? We pump out a show, we publish it Sunday, record Thursday, edit, publish Sunday. And then we say this week will be in Spaces talking about the episode.
Okay, so you want to do one week Spaces, 1 week's podcast? That works too.
Yeah, I think that's good. Then you kind of have that sort of flow and the opportunity to discuss every episode.
Yep.
All right. So yeah, same deal. We'll push it out on Sunday night and then say, hey, book the Spaces.
Yep.
Yeah.
I was gonna ask something else. What do you think? What do you think about changing just the font for Ethereum Bowl from like it's kind of this cursive font to more of a, like a non-cursive font? What do you think?